Hey everyone, and welcome back to The Explainer. I am absolutely thrilled you're joining us today because we're looking at a literal masterclass in economic contradictions. If you've been paying any attention to the Indian financial landscape lately, you might be feeling a little bit of whiplash. Today, we're going to completely unpack the fascinating forces that are pulling the Indian economy in totally opposite directions. Think of it like a giant economic tug-of-war, where you've got these incredibly powerful domestic strengths battling it out against some seriously intense global headwinds.
And honestly, it all boils down to one glaring paradox. How in the world can the stock market experience a massive boom, while literally at the exact same time, the national currency hits an absolute record low? I mean, it sounds impossible, right? Usually these two things move hand in hand. But right now, they're telling two completely different stories. So to really understand who's winning this tug-of-war, we need to break down the hard data, piece by piece.
Okay, let's dive into this. First up, the strong market comeback.
Just look at the numbers. The BSE Sensex surged by a massive 790 points, closing really strong at 75,398. And the Nifty, it followed right along, closing comfortably above that 23,650 mark. You know, these aren't just minor daily fluctuations. We're talking about a roaring domestic market rebound that absolutely demands our attention.
Which brings us to part 2. Corporate giants see surge.
A major catalyst pushing this forward was the Adani Group. We saw this massive block deal involving Adani Enterprises to the tune of 1,435 crore rupees. And the market reaction was immediate. That single transaction pushed shares of Adani Enterprises to a brand new 52-week high of 2,712 rupees, effectively pulling the broader indices right up with them. Now, let's look at another heavyweight adding fuel to this domestic boom, JSW Steel. They just reported their consolidated net profit, and wow, the figure is staggering. 19,243 crore rupees. At first glance, a number like that makes the whole domestic corporate environment look practically invincible. Now, what's really interesting about this piece of data is the context. That 19,243 crore wasn't your standard everyday operational growth. It was actually driven entirely by a one-time gain. So we're looking at a temporary windfall here, rather than sustained month-over-month operational scaling.
But on the actual operational side of things, we have MTAR Technologies. They managed to secure a massive international order, worth exactly 2,279 crore rupees. And that is exactly the kind of concrete, forward-looking win that builds genuine bullish momentum.
Moving on to our third point. Pharma sector stands strong. Let's take Cipla, for example. They actually experienced an overall profit dip recently, mostly due to broader economic headwinds. But here's the catch. Their Indian business operations, those grew by a really robust 15%. And let me tell you, the market absolutely loves that kind of local resilience. Thanks to that 15% domestic growth, Cipla actually saw their shares jump by 4%. The market basically looked right past the broader profit dip and chose to reward that core domestic strength. All right, let's shift gears a bit. Point number 4. IT sector faces AI threat. This is where the tug-of-war really starts pulling in the other direction.
We saw a very direct cause and effect happen here. When OpenAI announced a massive new $4 billion investment, the immediate ripple effect was a heavy, panic-driven sell-off in the Indian IT sector. This led to a sharp 4% drop in the Nifty IT index. Make no mistake, global advancements in AI are creating real palpable anxiety about the future of traditional IT services, and that anxiety is pulling hard against the domestic market's upward momentum.
Which leads us to our 5th point. Global crisis hits the rupee. So right alongside that AI-triggered IT sell-off, the Indian rupee has simultaneously dropped to an absolute record low of 95.86. Why? Well, investors are essentially fleeing to safe haven currencies because of the escalating crisis in West Asia. It's putting immense, undeniable downward pressure on the rupee, even while the domestic stock market surges ahead. It's wild.
So, how does this all resolve? Let's look at part 6, Future Indian GDP Outlook. Despite all of this turbulence, the long-term outlook remains remarkably optimistic. The International Monetary Fund actually upgraded India's GDP growth forecast for the financial year 2027 to 6.5%. Think of this number as the anchor in our tug-of-war. It basically shows that structurally, the domestic engines of the Indian economy are powerful enough that global financial institutions are betting on it to continue growing at a highly competitive rate.
Which leaves us with this final critical question. We've mapped out the whole tug-of-war now. On one side, you have incredible corporate profits, massive domestic orders, and an IMF-backed growth target. But on the other side, you've got the undeniable reality of AI disrupting the foundational IT sector and rising global tensions in West Asia seriously battering the rupee. So, can India's domestic growth engines pull hard enough to sustain that 6.5% momentum through the global storm? It is absolutely the defining economic question for the region right now. Thank you so much for walking through this explainer with me. Keep analyzing the data, and I'll catch you next time.